So welcome to all of you Shiksha 360, and today basically we will discuss chapter number 30, that is RAROC and profit planning part 1. Yeah, this is basically part 1. Let's start. So basically, first of all, basically we want to discuss basically what are the content basically we have to discuss in this chapter. Clear? So in this unit, clear, in this session, basically we will see the factors clear that is affecting the profitability of the banks. Clear? Basically, first of all, basically we will see basically what are the factors. Clear? Basically, what are the factors basically that are affecting the profitability of the banks. So further, basically banks are required to maintain a certain minimum amount of capital. Clear? Basically, banks are required to maintain a certain minimum amount of capital, basically based on their risk profiles. Clear? Basically based on their risk profiles. Clear? So we shall now look at the various options for deployment of funds. Clear? Basically where they have to put their funds and their impact basically on the bottom line and capital requirement. Clear? And their impact basically on the bottom line and the capital requirement. Clear? So let's discuss one by one. First of all, basically we have to discuss regarding the profit planning. Clear? Profit planning. Clear? Basically how basically we have to place our funds in such a way so that basically we will get some profit. Clear? So that basically we will get some profit. Clear? Profit planning. Clear? So basically banks are commercial organizations. Clear? Basically banks are commercial organizations. They are there to earn profits. Clear? Basically banks are commercial organizations. They are there basically for what? Basically to earn the profits and provide good returns basically on the equity. Clear? Basically banks are commercial organizations. They are there basically for what? Basically to earn the profits and provide good returns on the equity. Clear? Basically they are there basically for what? To earn the profits. Clear? Basically what is the main motive of the banks? Basically to earn the profit and to provide good returns on the equity. However, they have the role of the financial intermediary. Clear? They also play the role of the financial intermediary. So basically what is the main function of the bank? Clear? What is the core function of the bank? Basically to accept deposit and lend money. Clear? So basically banks accept deposits and lend money basically to the industry, trade, agriculture. Clear? Basically banks accept deposits and lend monies basically to where? To the industry, trade, agriculture, consumption, housing, etc. Clear? So basically generally they are the trustees for the deposits kept with them. Clear? Basically whom? Basically banks are the trustees. Clear? So basically here banks are the trustees basically for the deposits. Clear? Basically banks are treated as the trustees for the deposits kept with them and have to perform the sacred duty of protecting the depositor funds. Clear? And has to perform. Clear? And further basically they has to perform the sacred duty. Clear? Of protecting the funds of the depositors. Clear? Of protecting the funds of the depositors. Further basically they are also expected. Clear? They are also expected to give us some fixed returns to the depositors. Clear? Basically they are also like basically under the fixed deposit. Clear? Like basically you have to pay as per the basically agreement between the customer and the bank, that is 5.20 interest rate or 5.30 interest rate. It depends upon case to case or the time scenario. Okay? So they are also expected to give some fixed returns to the depositors. So in this capacity as a trustee for the depositors, a bank role may have variance basically with its responsibility. Okay? A bank role basically may have variance basically with its responsibility to maximize the profits basically for its owner. Clear? So in this capacity, basically as a trustee for the depositors, a bank role basically may have variance. Clear? A bank role basically may have variance with its responsibility. Clear? Basically with its responsibility to maximize the profit basically for its owner. Clear? Basically with its responsibility to maximize the profit for its owners. So banks are therefore, clear? Basically banks are therefore required to be cautious. Clear? Banks are therefore required to be cautious in their dealing and manage the risk basically in a prudent manner. Clear? So here therefore banks are therefore required to be cautious. Clear? Basically banks are therefore required to be cautious in their dealing and manage the risk basically in a prudent manner. Clear? And manage the risk basically in a prudent manner. Clear? That is all basically comes under the profit planning. Clear? That is basically how they have managed their funds. Clear? And how they have managed the depositor funds to take profit from that. Clear? To get profit from that. So basically profit planning in a bank. Clear? Profit planning basically in a bank essentially involves balance sheet management, that is covering credit, investment and non-fund based income. Clear? Non-fund based income. Clear? The first question which they will ask in the examination. So basically bank income arises basically from which three sources? Clear. The first question which they will ask in the examination. Clear. Basically, which of the following are the sources of the income? Clear. First one here, that is the interest income. Second one here, that is the fee-based income. Third one is the treasury income. Clear. So basically, these are the sources. Clear. So bank income basically arises basically from three sources. First one here is the fee-based income. Second one is the interest income. Third one is the treasury income. Clear. Third one here, that is the treasury income. So now let's discuss very, very important. On the basis of that, basically we have to discuss one case study. Clear. That are given in the book in the form of the example. Clear. In the form of the example. Clear. So they can give this type of question basically in the examination also. Clear. So basically interest income is derived. Clear. Basically from where the interest income is derived, basically interest income is derived basically from the lending as well as investment in securities, bonds, etc. Clear. Either from the lending, basically we can see that from the loans, or as well as basically investment basically in the securities, bonds, etc. So in most of the countries, clear, basically in most of the countries, there are norms that a certain percentage, clear, basically in most of the countries, basically there are norms that a certain percentage of deposits basically is mandatorily required to be kept in the government securities. Clear, basically in most of the countries, basically there are norms that a certain percentage of the deposit, clear, that a certain percentage of the deposit basically is mandatorily required to be kept in the government securities. Clear, basically to be kept in the government securities. In our country, basically this requirement is to be known as the SLR. Clear. In our country, basically statutory liquidity ratio basically takes care of this aspect. Clear, that is investment in the government securities. So basically, though the investment basically in government securities are practically risk-free, clear, because these are government securities, there are not any risk, clear, but the earning on these government securities is also very less. Clear, is also very less with regard to other. Clear. So the investment basically in the government securities are basically practically risk-free. The yield on such investments is lower. Clear. The yield on such investments is lower. Clear. Similarly, the interest income on highly rated corporates, clear, basically similarly the interest income on highly rated corporates are much lower, basically are compared to the income on the lower rated corporates. Clear. So if they are higher rated, so basically we are earning more from that. Clear. Similarly, the interest income basically on the highly rated corporates are basically much lower. Clear. Basically if they are highly rated, the return from that is basically are much lower as compared to the income basically on the lower rated corporates. Clear. But there are more risk. Clear. Basically where there is more return, there is more risk side by side. Clear. So basically banks are required here. Banks are required basically to have a proper blending of investment basically in the government securities and credit portfolios. Clear. Banks are required basically to have a proper blending of investment basically in the government securities and the credit portfolios, basically to maximize the profit. Clear. Basically for what? To maximize the profit for a given level of risk appetite. Clear. Basically for a given level of risk appetite. Clear. Like it means that we have not to take much risk. Clear. Basically we have not to take much risk, and basically we will get the maximum return from that. Clear. Basically we will get the maximum return from that. Clear. So basically we have to manage in that way. Clear. Basically we have to manage in that way so that basically we will get maximum return. Side by side, basically we will also get less risk. Clear. Basically side by side, basically we will also get less risk. Clear. So let's discuss one example. Clear. So let us take one example of various combinations. Clear. Suppose a bank has rupees 1,000 to invest or lend. Clear. Basically a bank has rupees 1,000. Now basically what they have to do, basically either they have to invest rupees 1,000 or they have to lend rupees 1,000. Clear. So basically these are the two cases. Clear. Basically same, either they have to invest or lend. Clear. So basically now basically we will check four scenarios. Clear. Basically on the basis of that, basically now basically we will check four scenarios, basically how it plays their role. Clear. How it plays their role. So the example on your screens now. Clear. This example is given in the book. So now let's discuss regarding that. Clear. So now let's discuss regarding that. Basically what they are saying, that basically how to analyze. Clear. Very, very important and easy example. But now basically we have to understand here basically what they want to say here. Clear. So here basically they are saying that basically there are four scenarios. First scenario, second scenario, third scenario, fourth scenario. So basically they are investing basically rupees 1,000 in four different ways. So basically first one, that is investment in government securities, basically with the yield 6% and risk weightage of 0%, clear, and risk weightage of 0%, clear. So basically they are investing total 1000 rupees basically in that field only. And here basically yield is 6%. So basically total investment basically in that is only in the government securities. So basically total yield is 6%. So 6% of 1000. That is a 60 rupees, clear. That is 60 rupees, and here yield is a 6%, clear. Here yield is a 6%, clear. Further, there is not any risk weighted, 0. So capital required basically for the risk weighted asset is also 0, clear, because there are not any risk weighters, clear. Basically there is not any risk, clear, by investing in that, clear. So capital allocation basically for that also is a 0, clear. Basically for that also is a 0. Now in the second case, clear. Now in the second case, basically they have also now rupees 1000. Now what they will do here? So basically here, basically that is lending to AAA rated customers, clear, along with the investment in the government security. Here basically they are lending to the AAA rated customer, basically where they will get yield is 8% per annum and the risk weightage of 20%, clear. So here 400 rupees basically investing in the government securities, clear, basically with the yield 6%. So basically 6% basically mean that they are earning rupees 24 here. And here basically AAA basically with 8%, clear. So 8%, so basically what they are earning, that is 48 rupees, plus the risk weightage is 20%, clear. So 20% of that is basically 120. 20% of that is basically 120, clear. So here total yield here is 72. How it comes? Basically 48 plus 24, clear. 48 plus 24 basically comes out to be 72. So basically yield percentage 7.2%. So here risk weightage is 120, clear. Here risk weightage is 120. So 120 basically how we'll get 20% of 600. 151,120. Clear. So 120 here. And the capital required for that is 8%. 8% of 120. This is comes out to be 56. 48 by 5, that is 9.60, clear. That is 9.60, clear. That is 9.60, clear. So I will tell you basically what is the meaning of all these things, clear. Now basically we are investing in the third, basically investment in the government securities is basically 300 rupees. So yield is 18, and here AAA, that is 300 rupees. So here yield is 24 and risk weightage is 60. Okay. Third one, basically now lending further to AA. Here AAA less risk. Now basically we are lending to AA rated customers. So basically they are more risk and more earning. Yield is 10%, that is 40. Risk weightage is 50%, that is 200. So total yield here 82. How it comes? Basically 40 plus 20, 60 plus 10, 70, 78 plus 4, 82. 78 plus 4, 82. So the yield is basically 8.2%, and risk weighted asset here is 200, here is 60, that is overall 260. And capital allocation here is to basically 8 upon 100, or we can say that 8 into 260 upon 100, that is 20.8, clear. That is 20.8, clear. So that is the capital requirement, clear. That is the capital requirement here in this case, clear. Now basically we will move towards the fourth point, clear. Now basically we will move towards the fourth point, basically here, and that is basically first one is basically investment in the government securities, clear. Basically investment in the government securities, basically with the yield 6% and risk weightage of 0%, clear. And basically with the yield 6% and risk weightage of 0%. So basically here yield 6%, that is 18 rupees. Risk weightage 0, clear. AAA rated customer yield is 8%, clear. Yield is 8%, we can say that 24. And risk weightage is 20%, that is 60. Here now basically 200 rupees, basically we are lent to the AA rated customer, yield is 10%. So that is basically we can say that 20 rupees yield. Risk weightage 50%, that is 100. So basically as basically we are lending to the low rated customers, as basically continuously basically we are lending to the low rated customers, there is continuously basically increasing in the risk weightage, clear. Basically there is continuously basically increasing in the risk weightage, clear. Now basically last one, that is lending to A rated customer, clear. That is basically lending to A rated customer. with the yield of 12%, clear, that is lending to A rated customer basically with the yield of 12% and a risk weightage of 100%, clear, that is totally risk. So here basically 12%. So what is 12% here is 12 upon 100 into 200, just 24 rupees and risk weightage of 200. So now calculate total yield here is 20 plus 20 40 plus 20 60 plus 68 plus 472 plus 478. I think at any place I am doing any mistake, please tell fast, or there is mistake here, please check. So here basically we are getting that yield here they are mentioning 86, clear. So that is 12 24 10 200 8 3 24 18. Okay, 20 plus 20 plus 20 60 78 82 86, clear, overall 86, clear, not any mistake, just calculation 86, clear. So yield here is that is 8.60%, and the risk weightage here is basically 360. How basically we can calculate? 200 plus 100, 300 plus 60, 360, and the capital allocation basically 8 upon 100 into 360, clear, 8 upon 100 into 360, clear, this much is the capital allocation, clear. So basically one thing basically we are here basically as basically we are taking more risk, clear, as basically more risk, that leads to the basically more earning. As basically we are taking more risk, more earning, and basically more capital allocation also, or we can say that more provisioning is required. Okay, so basically thus basically you would observe that the risk would increase, clear, that the risk would increase basically for lending to the lower rated customers, clear. Thus basically you would observe here that the risk would increase basically for lending to the lower rated customers, resulting in an increased need for capital, and also, clear, resulting is an increased need of capital basically continuously, basically we will see here continuously basically there is increased need for the capital allocation, and also improved yield on the assets, clear, that is yield is also continuously improved. Earlier basically 6%, now 7.2, 8.2, 8.60, clear. So basically banks need, clear, here basically banks need to optimize the investment and lending portfolio, clear, basically banks need to optimize the investment and lending portfolio to earn the best possible returns, clear, basically banks need to optimize the investment and lending portfolio to earn the best possible returns basically for a given capital level, clear, basically to earn the best possible returns basically for the given capital level. So basically banks have to take into account, clear, basically here basically banks have to take into account the effect of NPA on the net interest income, clear, on the interest income, and thereby on the profitability, clear, basically bank have to take into account the effect of NPA basically on the interest income and thereby on the profitability, clear. So basically NPA do not generate income. If the account is basically NPA, basically they are not generating the income, and therefore basically brings down the yield on advances, clear, because we are not generating any income from that account, clear. So basically NPA basically do not generate income, and therefore basically bring down the yield on advances, clear, and therefore basically bring down the yield on advances. Also under the Basel 2 and Basel 3 regime, clear, basically also under the Basel 2 and Basel 3 regime, the risk weightage of such assets is higher, clear, the risk weightage of such assets is higher. So thereby basically forcing a bank, clear, so thereby basically forcing a bank to maintain higher capital, clear, so thereby basically forcing a bank to maintain higher capital, clear. So thus NPS, clear, so this basically does NPS have a twofold effect, clear. So thus NPS basically have a twofold effect, that is reduction in the income and need for additional capital, clear. Thus NPS basically have a twofold effect. First one basically that is the reduction in incomes, and second one basically need for additional capital, clear. And second one here that is basically need for additional capital, clear. So thus NPS basically have a twofold effect, that is first one is the reduction in income and need for additional capital, clear. So hence return on capital or profitability basically gets further deteriorated, clear. Hence we can say that basically return on capital, clear, hence basically return on capital or basically profitability basically gets further deteriorated. Clear? Basically, if the account is going into the NPA. Clear? If the account is going into the NPA. So what are the second activity? Clear? This first one is the major source, that is interest. Clear? Basically, we have discussed three, that is interest income. We have discussed rupees 1,000 example. Now basically we will move for the fee based income, and next one basically the treasury income. Clear? Now basically we will move for the fee based income. So the second major source, clear, the second major source of income is derived from the fee-based income activities, clear, or fee-based activities, clear. So the traditional activities such as demand draft, remittances, safe custody, guarantees, letter of credits, bills, etc., continue to be prevalent, clear, basically continue to be prevalent, clear. However, with the technology changes, clear, basically, however, basically with the technological changes, some of the services, clear, basically, however, basically with the technological changes, some of the services such as demand draft, remittances, bill handling basically may reduce drastically, clear. Basically, some of the services such as demand drafts, remittances, bill handling basically may reduce drastically. So some new services, clear, basically in the place of that, basically some new services like depository services, internet banking, e-commerce basically have appeared on the scene, clear. Basically, some as the passage of the time, clear, basically there are less demand for these services. On the basis, in the place of that, clear, some new services like depository services, internet banking, e-commerce basically have appeared on the scene, clear. Basically they have appeared on the scene, clear. So these services, clear, basically these services have given a boost to the fee income, clear. Basically these services basically have given a boost to the fee income, or else have resulted basically in a higher minimum balance requirement, clear, or basically resulted, or else have resulted basically in a higher minimum balance requirements. So the banks here, the banks have been introducing several innovative products, clear. The banks have been introducing basically several innovative products and services with the advent of technology, clear. Basically with the advent of the technology, or basically we can say that as the technology is basically increasing, all the earlier services, clear, basically all the earlier services basically have not in great demand. And basically we can say that like basically presently the mobile banking or internet banking, clear, or e-commerce, clear, all are in the great demand, clear. So basically now basically we have to start income from these things, clear. Basically fee based income, like basically for the RTGS, earlier basically you have to go to the bank, clear. Now basically you can done through your mobile phone also, clear. And in the bank basically they will charge more amount, and in the mobile banking basically amount charging is also less, clear. Amount charging is also less, clear. And there is not any other requirement, clear. Just basically you have to log in and do the transaction, clear. Banks have also ventured into cross selling, clear. Basically banks have also ventured basically into cross selling of other financial products, clear. Basically banks have also ventured basically into cross selling of other financial products basically such as insurance policies, mutual funds, etc., with established network, clear. Basically with established network and position of trusted entity, clear. Basically with the established network and position of trusted entity basically for its customers, clear. Banks have also ventured basically into cross selling of other financial products such as insurance policies, mutual funds, etc., clear. With the established network, clear. Basically with the established network and position of trusted entities basically for its customers, a bank can make logical and natural entry basically in the selling of third party products, like basically we can say that like insurance or mutual funds. So basically banks thus tend to become a financial supermarkets, clear. So basically banks thus tend to become a financial supermarkets, and such measures, clear. Basically and such measures basically help increase the fee based income, clear. So basically banks thus tend to become a financial supermarkets, and such measures, clear. Basically and such measures basically help increase the fee based income, clear. And such measures basically help increase the fee based income, clear. So basically banks are required to keep in mind the operational risk, clear. Basically further basically banks are required to keep in mind the operational risk basically associated basically with these new services, clear. Operational risk basically associated basically with these new services, clear. So that are basically come into the fee based income, clear. Third one basically that is treasury income, clear. That is treasury income basically related to the trading activities, clear. That the treasury income basically related to the trading activities, clear. So the last and the most important component of the income basically is the treasury income. basically which is derived by trading in the securities, clear, basically which is derived by the trading in the securities or foreign exchange or equities or bullion or commodities and derivatives, clear, equities, bullion, commodities and derivatives, clear. So basically this is largely a speculative activity, clear, that is speculative activity basically which banks undertake basically with the stringent internal controls and checks in place, clear, because there is a chances of losing all the money in one case, clear. So basically they have to do this type of work very carefully, clear. So basically this is largely a speculative activity basically which banks undertake with the stringent internal controls and checks in place, clear. So regulators also prescribe basically various measures basically in this regard, clear. Regulators basically also prescribe various measures basically in this regard, clear. So basically banks put in place several risk management measures, clear, basically banks put in place several risk management measures such as caps basically on the open positions, mark to market valuations, capital provisioning basically based on value of risk, etc. Clear, basically capital provisioning basically based on value of risk, etc. Clear. So basically banks put in place several risk management measures basically such as caps on open positions, mark to market valuations, capital provisioning basically based on value of risk, etc. Clear, basically based on valuation of risk, etc. So trading activities, clear, basically trading activities basically may provide large income to the banks, clear, basically trading activities basically may provide large income to the banks. So this has been the case basically with the many Indian banks basically during the last 3 years, clear, basically during the last few years, clear. So these activities, clear, basically these activities basically may result in large amount of losses as well, clear. Along with the profit, basically these is also leads to the loss to the organization, clear, loss to the organization. So basically if a bank is not adequately capitalized, so such losses basically can cause serious problems for it, clear, basically can cause serious problems for it, clear, if these risks are not properly managed, clear. Like in the 90s, basically Baring Bank, a very old British bank, basically collapsed due to very large losses basically on the exchange. So it is important to undertake, clear, basically it is important to undertake trading activities basically within one means and exploit the potential basically to earn more income for a bank, clear. So basically it is important to undertake trading activity basically within one means and exploit the potential, clear, basically and exploit the potential basically to earn more, clear, and exploit the potential basically to earn more for a bank, clear, and exploit the potential basically to earn more for a bank. So that is basically treasury income, clear. So that is basically treasury income, clear. So on the other side, clear, these are the income sources, clear, basically these are all the 3 income sources. Now basically where they do are spend the money, clear. So basically on the expenses side, basically there are 2 major expenses. First one is the interest expenses, second one is the operating expenses, clear. Interest basically which we have to pay, and second is basically operating expenses, clear. Second one here, that is operating expenses. So basically there are 3 major parts of the deposit portfolio, that is current deposits basically which are interest free, clear, basically on which basically we have not to pay any interest, clear. Second one is the saving deposits which get a regulated interest rate basically of 3.5% in our country, clear, just basically as a average value basically we will take, clear. And next one is basically term, that is short and long term deposit, that is basically fixed deposit, clear, basically for which interest rates are deregulated in India, clear. Basically for the term deposits, clear, basically for interest rates on that basically it is to be managed by the banks, clear. So basically thus a bank has to find basically ways and means basically to improve the share of low cost deposit, that is to enhance the deposit basically in the current accounts such as current and saving banks, clear. This helps them to lower the interest cost, clear, basically to lower the interest cost. So interest rates basically on the term deposits basically are largely decided by the market forces, clear, or basically we can say that by the competition, clear. Basically if any bank basically giving 4% interest rate, so basically other bank basically will try to give at least a little bit more, either basically 4.05, clear, so that customer will attract towards them, clear, so that customer will attract towards them, clear. So basically bank keeps such interest basically at a level at which basically it can garner requisite deposits basically in competition basically with respect to the other banks, clear. So bank can keep such interest basically at a level at which basically it can garner basically requisite deposits basically in competition basically with the other banks, clear. So these interest rates are also influenced by other instruments, clear, basically these interest rates basically are also influenced by other instruments basically such as debentures, postal deposits, government securities, provident fund, etc., clear. So basically these interest rates are also influenced basically by other investments such as debentures, postal deposits, government securities, provident fund, etc. Clear? So that is basically comes under the interest expenses. Second one is basically that is operating expenses. Clear? That is salaries to their employees. Basically, we can say that, or basically electricity bill or all other types of bill. Clear? So the second factor of expenditure basically is the operating cost, which consists of staff cost and other costs. Clear? Basically, operating cost basically consists of staff cost and other costs. So basically, banks continuously basically try to improve the productivity. Clear? Basically, banks continuously basically try to improve the productivity and also link up basically some of the staff costs. Clear? Basically, banks continues try to improve the basically productivity and also link up some of the staff costs basically to the productivity by providing incentive based packages. Clear? So basically, banks try to improve the productivity and also link up some of the staff costs basically productivity by providing incentive based packages. Clear? So thus every effort is made to maintain. Clear? So basically thus every effort basically is made to maintain and reduce the percentage of staff cost basically to the income level. Clear? And reduce the percentage of basically staff cost to the income level. Clear? So other cost comprises. Clear? Basically other cost comprises basically depreciation, rent. Clear? So other cost comprises basically depreciation, rent, utilities, legal expenses, traveling expenses, postages, telecommunication charges, stationery, etc. Clear? So basically other cost comprises basically that is depreciation, rent, utilities, legal expenses, traveling expenses, postages, telecommunication charges, stationery, etc. Clear? So basically banks, like any other commercial organization, would ensure that basically wasteful expenditures basically are avoided. Clear? That is basically wasteful expenditures are avoided and best possible deals are achieved. Clear? Wherever possible. Clear? And best possible deals are achieved basically wherever possible. Clear? Cost benefit aspects basically are looked into and alternatives are explored. Clear? Cost benefit aspects basically are looked into and alternatives are explored. Clear? So thus basically every effort to rationalize this segment of expenditure is made. Clear? Basically they will try to reduce. Clear? Basically lower down the operating cost. Clear? Or basically interest rate. Clear? Both. Try to lower down the basically expenditure and increase the income. Clear? And increase the income. So basically in the nutshell, basically what we have to say that basically profitability, it is a function of 6 variables. Clear? Profitability basically it is the function of the 6 variables: interest income, earning; fee based income, earning; trading income plus; interest expenses minus; staff expenses minus; clear? Operating expenses minus. Clear? So basically maximization of the first 3 variables and minimization of the last 3 variables basically are the requisite to maximize profitability. Clear? So maximization of the first 3 variables and minimization of the basically last 3 variables. Clear? Basically are the requisites basically to maximize the profitability. Clear? Are the requisites basically to maximize the profitability. Clear? So all the 6 factors. Clear? Basically all these 6 factors basically are dependent on each other and achieving the optimum level is the requirement here. Clear? So all these 6 factors basically are dependent on each other and achieving the optimal level. Clear? Is the requirement here. That is basically we have continuously increased our income and reduced our expenses. Clear? Basically it also leads to the net operating profit. Clear? Net operating profit. Clear? So basically if the operating profit is good for any financial organization. Clear? So presently as per the government guidelines, clear, the employees of that organization basically we will get PLI. Clear? That is profit linked incentives. Clear? So basically every year basically many banks, basically employees of the many banks, clear, basically will get profit linked incentive. Clear? Profit linked incentive. Clear? So basically these are the main points regarding the profitability. Clear? Regarding the profitability. Clear? So in this session basically we have to discuss up to this much point. Clear? Hope it is clear to all of you. Very, very important is this one. Clear? This one. Clear? Basically you have to understand this thing. Clear? Because they will ask sometimes very basic question on the basis of that. Clear? Basically which we have already calculated values here. They will ask in the examination basically in the form of the question. Clear? In the form of the question. Clear? So thanks to all of you for joining this session.